Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is credit risk transfer for regional and community banks, a path back to growth. My name is Stuart Litwin. I am a partner at Mayor Brown. I have been here for 40 years. 20 of those years I've spent as head or co-head of our structured finance practice. I spend a great deal of time working on structured finance transactions designed to achieve favorable regulatory capital and accounting results. For purposes of this topic, I have the distinction of having been the lead lawyer on the first ever synthetic securitization in the United States, the Sherpas transaction involving a reference pool of subprime mortgages done by the Provident Bank in 2001. With me today is my partner, Matt Bisanz, and Matt is a bank regulatory partner in our Washington, D.C. office. He is knowledgeable in all major aspects of the operations of an insured depository institution, its affiliates, and its partners, including capital and liquidity regulations and the Volcker Rule. And we're going to cover a number of really interesting topics. We're going to cover some of the pressures that are facing small and medium-sized banks. We're going to talk about what is a synthetic securitization. We'll talk about some of the structures used by banks to get capital relief. We'll talk about some of the asset classes that have been used as reference pools in these transactions. We'll talk about some of the unique issues where banks have tried to get capital relief for commercial loans of different sorts. And we'll talk about how to bring credit risk transfer transactions to smaller banks, including community banks. And with that, I'll turn it over to Matt, who's going to talk a little bit about some of the pressures that are facing small and medium-sized banks.
Thank you, Stuart. So if anyone who's been seeing the news in recent months can tell, the economic climate has changed dramatically. And that is true not only for the Main Street economy, but also for what banks are facing. That the lifeblood of a bank is its deal flow, its pipeline of loans that it is transacting in. And right now, because of the higher interest rate environment and some of the other economic pressures from inflation, existing loans are not being refinanced. They're remaining on the balance sheets of banks at their initial low interest rates. And that is putting pressure on banks first from, as I said, the pipeline perspective, but it also is creating a mismatch of interest rates because banks have their deposits that are being used to fund those loans, and the interest rate on those deposits keeps ticking up with the market. And so banks really can't fund new loans or even fund their existing loans in the same efficient manner. The alternatives are not particularly desirable, that if they wanted to take more deposits, they'd again have to pay a very high interest rate on those. And so it's expensive or unavailable in the post-Silicon Valley bank world. Also, other fundraising techniques like raising equity in the capital markets, that can be dilutive or just unavailable for some of the community banks that maybe aren't even publicly traded. Traditional debt offerings also might be beyond the capabilities or beyond the financial profile of community banks. And so all of these are pressures that are restricting bank lending or even impairing a bank's balance sheet based on the changes in the net interest margin spread. So these community banks out there, the hopeful listeners to this podcast, are trying to figure out how they can get some relief on the balance sheet and maybe even make new loans, get some capacity back to make new loans. And one technique that we are seeing a lot of interest in from clients, it's called a synthetic securitization. And that's a fancy word, but really it's a technique, and Stuart in a minute will describe some of the ways it's done, but it's a technique to extract the credit risk from a portfolio of loans and give that credit risk to a third party. And so the loan stays on the bank's balance sheet. All the customer relationship is preserved. All of the servicing remains as it was prior, but the credit risk is extracted and transferred to a third party who is paying, or who is paid a fee by the bank for holding that credit risk. And so the third party now has the advantage of getting this credit risk exposure without all of the burdens that come along with holding the loan, which is, those burdens are what the bank wants to hold on to. And so that's what a synthetic securitization is conceptually, but maybe Stuart can put some framework around the structures used for it.
Thanks a lot, Matt. I'd be glad to. So when we look at some of the structures that banks have used to transfer risk and to get capital relief, of course, the most common that banks have used for a really long time, the first is to simply sell assets in whole loan sales. That happens all the time. It continues to happen. We've been seeing a lot of those transactions in the recent past with different levels of complexity. And in some cases, the banks have been providing seller financing for some of those transactions. We've also, in the traditional securitization market, of course, seen banks do residual sales to get off balance sheet. But really, the most important thing that we're talking about today are synthetic securitizations. And probably the most common synthetic securitization structure we're seeing are credit-linked notes. Now, a credit-linked note is a note that will be paid unless there are losses on the reference portfolio. And those notes get tranched, and typically the bank doesn't issue notes for the AAA portion of the structure, and may issue all the way down to the very bottom, but usually there is some unrated portion at the bottom where the bank leaves itself exposed to a handful of basis points of losses. When you think about a credit-linked note, think about a guarantee, because they really are very, very similar in form and in function. So with a credit-linked note, you're going to pay the note unless there are losses on the reference portfolio. The guarantor has the obligation to effectively insure against losses on the underlying reference portfolio. And if the guarantee puts up the cash for its guarantee up front, that's just the same thing as the initial investment in the notes. And just as the notes pay when there are no losses on the portfolio, when you think of it as a guarantee, the guarantor gets its cash back as the guarantee becomes unnecessary because the underlying reference portfolio is in fact getting paid. So credit-linked notes have become a very common form of CRT transaction, and they have an important benefit that I'll get into when I talk about the next structure, which is a credit default swap. So under the synthetic securitization provisions of the capital rules, you can have either an eligible guarantee, which the credit-linked notes provide, or you can have an eligible credit derivative, and credit default swaps work for that purpose. The important negative of the credit default swap is that under the accounting rules, you're required to mark derivatives to market. With the credit-linked note, if structured as a financial guarantee, you don't have to have a mark to market. You can structure it so that you can avoid having that mark to market and avoid some of that both complexity and the volatility in earnings, which a lot of banks really want to have. we just talked about some of the structures, but let's also talk about some of the asset classes that have been used in credit risk transfer transactions. Typically, the asset classes are just about anything the bank has on its books that are low loss, high quality assets that have a low return. So it's the kind of asset that it's not a risky asset, and the return is sufficiently low that it just doesn't justify the high capital charge that you would have if you don't do a credit risk transfer. So we've seen these in both consumer assets and increasingly commercial assets. The kinds of consumer assets we've seen a lot have been mortgages, auto loans, and other types of installment loans. There are certainly other kinds of consumer assets that can also be used to get credit protection for CRT transactions, but mortgages and auto loans definitely have been, the most prevalent. On the commercial side, banks are really trying to look at their entire portfolios of low loss, low return assets. And we've seen leveraged loans, we've seen subscription lines of credit, we've seen trade finance assets, but literally the banks that are our clients seem to be looking across their entire portfolios to find anything that just doesn't have the return to justify the capital cost. With that, I'm going to turn it over to Matt, who's going to talk a little bit about the requirements under the capital rules to get capital relief for a transaction like this.
Thanks, Stuart. And so, as we've been talking about that banks want to do this, maybe to put a little flesh around why they're doing this. That if you have one of those commercial loans that Stuart was talking about, a bank will have what's called 100% risk weight to it, and that 100% risk weight effectively means that the bank is holding 8 cents of capital for every dollar of loan, and that's for the entire amount of the loan. With a synthetic securitization, recognizing the credit risk mitigating effect of the guarantee, the credit derivative, the financial collateral, that the regulators allow a bank to lower the risk weight for the loan. And so instead of having a 100% risk weight, it may go as low as a 20% risk weight. And as Stuart said, this recognizes the fact that the bank is less likely to incur losses because it has sold the portion, or it has purchased the protection, it has sold a portion of the credit risk to the third party. In order to obtain that recognition of the credit risk mitigating effects of the credit linked note, the guarantee, et cetera, there are various conditions that are imposed under the regulations. And some of the key ones are that there must be tranching. So there's the portion that's retained by the bank. There's the portion that is sold to the protection provider. There is there's the fact that it's based exclusively on the performance of the underlying exposures. We're not looking at the credit worthiness of the bank or any affiliates of the bank. It needs to be with reference to financial exposures, so things like loans, receivables, lines of credit, other types of debt securities, all financial exposures, not commercial exposures. And then there are certain other operational requirements, and this goes to the fact that there must be either financial collateral, an eligible credit derivative, or other types of things like the guarantee. There needs to be due diligence requirements, that the bank must have an understanding of the features of the exposure. This means knowing the loan portfolio, the terms of it. And this is something that I think some people overlook, because many banks know these already, or many larger banks know these already, and have the technology in place to track the performance of the exposures in a granular manner from other types of securitizations or participations they may be doing. But again, this is something that some community banks may struggle with. And if a bank fails to comply with the due diligence requirements for understanding the attributes and performance of the loans, this can remove the exposure from the favorable 20% risk weight bucket and actually put it at an incredibly punitive 1,250% risk weight bucket. There are other nuances to the regulatory requirements, things as to what is the collateral that is being used to support the CLN. We can get into lots of esoteric discussions around things like cash on deposit, around what is a good collateral agreement, around what is a credit derivative, because again, credit derivatives aren't going to be a standardized product. They might be on standardized documentation like an ISDA, but there will be bespoke attributes to these. And so the requirements will be negotiated typically between the protection provider and the bank, with the bank trying to get comfortable that it will satisfy the regulatory requirements, or that it will at least get very close to the regulatory requirements, because it wants to get that 20% risk weight. So Stuart, could you tell us now maybe about some of the unique issues that come up with commercial assets as the underlying financial assets?
I'd be glad to, Matt. There are a lot of unique issues that relate to commercial assets as the underlying reference pool compared to consumer assets. But we only have time on this call to get into two very important ones. The first one is conflicts of interest. So when you think about a commercial pool, you're thinking about larger loans, you're thinking about loans that are not the kind of granular loans that you have with a consumer pool. So the customers tend to have bargaining power, and that leads to the potential for conflicts of interest. So you've got customer relationships that may span across the bank, and the bank may not only be a lender, the bank may have fee income opportunities of different sorts. They may get underwriting fees. They may have the opportunity to advise the customer on a merger transaction. So there are the potential for conflicts of interest. So how do you handle particular decisions where a customer may say, I need an amendment to my credit facility. If you give me this amendment, you are more likely to get that next merger assignment that I'm about to hand out. And those conflicts of interest are a challenge. And it's very difficult to get the bank sponsors of CRT transactions to be willing to forego and let investors manage those kinds of relationships. And the best way that these typically get resolved is through risk retention. Even where risk retention is not legally required, risk retention and aligning the interests through risk retention is a common feature in commercial transactions. The second issue that I'll talk about is the confidentiality of the borrowers and the relationship with the borrowers and the terms that the borrowers have under their respective credit agreements. And it's very important to the borrowers to have confidentiality. And so how do we manage a transaction like this, particularly when there is a workout in a commercial loan? How do we manage these kinds of things and recognize losses while still preserving the confidentiality for the borrower? And it's become very typical in these transactions to have a third-party verification agent. So there is a third party who the bank has enlisted, and they've signed confidentiality agreements, and that third party will help to make the determination about whether there's been a loss that gets protection under the CRT transaction. And with that, let's talk about some of the regulatory hurdles, and I'm going to turn it over to Matt to do that.
Thanks, Stuart. So there have been a large handful of CRTs that have been done over the last 2+ years, and typically under the capital rules, there is no requirement to obtain regulator approval. That if you fit within the box of a synthetic securitization and tick all of the items that I was describing a few minutes ago, you can recognize the lower risk weight on the pool of loans, and you report it on your call report that way, that there, again, is no approval requirement. That's what we believe, or at least we understand many banks have done, or who have recognized CRT transactions. However, sometimes a bank will either be unsure if it fits into the four corners of a synthetic securitization, or it may only fit into 3.5 corners of the securitization rules, and it wants some comfort that it can still recognize the relief. And we understand, and this is well reported in the press, that and a number of banks that we're familiar with also have encountered this issue of asking the regulators for permission to recognize synthetic securitizations, and not hearing back for many months. That it's over a year wait to hear back from regulators on whether or not they will permit a bank to recognize the capital relief that comes with a credit risk transfer. For larger banks, this can be a problem if the bank has to put those numbers into something like a stress testing CCAR type reporting. But for regional and community banks, they can get more comfortable that if they have a solid structured transaction, like the ones we've been talking about here, that again checks all of the boxes for being a synthetic securitization, they should be able to recognize the capital relief effects without obtaining any regulatory approval. That this just goes to the fact that the relief is self-executing based on the capital rules, and so if you have a compliant transaction, there's no need to get it. Banks still may choose to discuss it with the regulator to seek approval, but this isn't required, and at least in the deals that have been done, there's been no indication that the banks formally sought and obtained regulatory approval. That the deals involving the community bank sector have really, they've had press releases with them, and what we've seen has been that the banks have felt they complied with the requirements. And so I think that's how people in the community bank space are getting comfortable with these. Stuart, how would we bring this from just a handful of deals to the masses, as you like to say?
Yeah, so let's talk a little bit about bringing CRT to the masses. So not surprising, the first transactions were done by larger banks. They were creating documents. They hired lawyers to, the initial transactions obviously had a greater legal cost and a greater amount of time, a greater amount of work to, show the transactions to regulators and to otherwise carry them through to a closing. As time went on, those transactions were able to get repeated. And where we are today is that many folks are starting to think about ways to bring these transactions to smaller and smaller banks. And in order to do that efficiently, we have to be able to commoditize the transactions to a much greater extent. So what does that mean? It means taking our documents and truly creating forms. The biggest issue in trying to bring down the costs of CRT for smaller banks is whether or not the transaction needs to be rated. If the transaction needs to be rated, then that obviously increases the cost, but it also increases the time and the amount of financial analysis that goes along with the transaction. It's my guess that many of the transactions with smaller banks will wind up getting done without ratings, but with, of course, due diligence by the investors. There is also a great likelihood that some folks will try to create structures that involve multiple smaller banks, all in the same structure. And there may be approaches that enable rating agencies to compare these transactions to other transactions in the market. A good example is when you look at auto loans, and particularly dealer-originated auto loans. Maybe rating agencies can get comfortable with a set of criteria, perhaps with a lower advance rate and higher credit enhancement, but maybe rating agencies can get comfortable with a transaction that looks like other transactions that have been rated. And that brings us to the end of this podcast. I want to thank you, Matt, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thank you for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.